Now, it turns out that they had to make a lot of estimates of what the default rates would be. And those estimates were something else I could talk about at some length. Basically, the people who made the estimates didn't have my course. That's the best way I can say it. No, they were quantitative statistical people who looked at past losses of mortgages, and they looked at periods of time they thought was realistic. But we had a very nice economic run in the United States from 1946 to 2002, and based on the numbers during that period. But don't think about. And by the way, don't go to Texas in the 1980s. Don't include that in your survey because it doesn't happen again. And don't include the Depression because that doesn't happen again. And so based on relatively good economic times we had for a long time, they derived their notion of how much would default and how much protection had to be provided for the first tranche. So what they set up was the first tranche got paid first, and no one below got paid until they're satisfied with both income and principal, then the next in line, and then go get it rated. And there was a long period of time of educating the rating agencies. Because rating agencies were only accustomed to rating corporate debt. It took about 10, 15 years of hand-holding and before they would readily provide high levels of ratings or opinion of creditworthiness. Then you have the AA tranche, and then you add lots of levels of tranches. But what happens is the lower your tranche is, the chances are that you're going to take some losses. And so before you can sell the double Bs or the triple Bs, you're going to require a higher interest rate to take that risk. And now once you end up with that tranche structure, and by the way, it's really a lot more complicated. Okay, page 7. Portfolio of 206 subprime residential mortgages. The typical numbers at the time would be the top 80% went into the AAA category, which is really quite amazing that you get that much. Well, it's nothing compared to what they then did with it. The AA tranches, which were next in line, was 9%. The A tranches, 3%. And then the triple Bs, which is the lowest gradation of investment grade. But it's still investment grade. It's like as a student, it's like a B+. This is like A+, A minus, B+. Then you had, the gentlemanly B, and then you had C, etc. And then you had, at the very bottom, the ones that you didn't think were going to make it, so you couldn't get a rating at all. Now, if you're the investment bank and you're trying to sell this structure of tranches, this is a laydown, AAA, because those foreign banks had hundreds of billions of dollars. In fact, the numbers are, rather than keep going back, well, I skipped over it. It's page 5. Page 5, impressive growth. And what this shows for 203, 4, 5, and 6, the size of the foreign capital flows to the United States. And I wish we included 207 and 208 because it kept going until probably the first half of 208. 207 was probably the biggest. You can see $1.3 trillion coming in from abroad. $1.3 trillion. Now, to give you some order of magnitude, the GDP was about 14 trillion then. So this is about 10% of GDP of foreign capital coming in, looking for a home and looking for conservative investments. So the demand was huge. So it was very, very easy. In fact, these people were order takers. You call them investment bankers. They buy the mortgages on Monday. They have the lawyer put together the structure on Tuesday and register with the SEC. They get a fee for putting the mortgage package together. It's called underwriting. Then I guess they have corporate finance fee for putting together the security. And then they start selling the securities. But it's not selling at all because you had literally hundreds of billions of dollars of open orders of any U.S. derivatives of AAA. And it was just roll it off the shelf. It's a conveyor belt. Literally, it wouldn't take a week. Monday, they buy the securities. Tuesday, the lawyer would run the stuff through the SEC. And then they'd call up people and say, we got product available. Now, what was a laydown was getting rid of this stuff and even this stuff and even this stuff. But what made this thing to work, they also had to get rid of the lower tranches. Because if they didn't sell the lower tranches, they got stuck with those on their balance sheet. And they didn't want it because they had some inkling how bad it was. So the big problem becomes, how do you get rid of this thing? Doesn't work for the investment banker unless they get rid of the lower tranches. You know, the stuff that's likely, what we call now toxic waste, the stuff that's likely to default. So the question is, how do you market it? Page 12. Who bought the tranches? Well, the foreign sovereign wealth funds, foreign central banks, they started to break away from treasuries and get into this even. And then the foreign commercial banks, investment banks, and their institutions, their endowment funds, highly conservative. They all need income to produce, you know, like UT needs income to generate the electricity for this room. So if endowments need a cash stream. So a lot of it was foreign. They bought the high quality, the AAA and the AA. Then the question becomes, who bought the lower grades? And you've heard quite a bit about the development of the hedge fund industry. The reason the hedge fund industry had a mercurial growth, about 500% growth in that period of time, is they were buying the lower tranches. And the lower tranches would have a high interest payment and a lot of risk. And how did they buy them? Well, to some extent, they raised capital from U.S. institutions. On top of that, they found another source of foreign capital called the carry trade, which tended to be sopping up the excess liquidity in banks across the world. In particular, the cheapest money was from the Japanese banks. And so they would get some institutional capital and go out and lever it up 10, 20, 30 to 1 with basically Japanese money. That was 2-3%. So the lower tranches could pay 10, 15%, and their cost of money would be 3%. The difference they'd live on, and they'd put 20% of it in their pocket. And as long as the game went on, they looked like geniuses. The buyers of the low ratings had risk. The hedge funds, at first, I guess, reconciled themselves, well, we're in the risk business, we'll take the risk. But after you have such a deluge of this stuff coming down the pike, they fill their boat, and then the question is, how do you get rid of this stuff? And to enhance the credit of the low-quality tranches, they knocked on the door of someone you now know about called AIG. And AIG, which was at that point the most successful insurance company in the world, and they said, how about instead of selling insurance on this building, for example, instead of selling property insurance, how about selling financial insurance? And what we would do, like an insurance product, is pay you a fee. And this would be the investment bank who put it together. We will pay you a fee to insure the poorer tranches. And that is what is now called the CDS market, the CDS credit default swap market. And what came about in the 2002-2007 period was the mushrooming of financial insurance. It's an infant industry. And as an infant industry, they had no standards. They never, all those who insured never showed on their balance sheet the extent of liabilities they had, and which is now the source of an awful lot of litigation. They never showed reserves. They were not regulated. It was a totally new industry. Henceforth, it will be. But it was amazing the extent to which companies like AIG, can I give you an order of magnitude? AIG's insurance outstanding was $2.6 trillion on that kind of stuff. $2.6 trillion. To give you a yardstick, the total capital of the United States banking system is $1.3 trillion. They insured $2.6 trillion. So they not only basically insured a quantity of securities that basically making the U.S. banking system whole, but the foreign banking system whole. All with one company with no reporting out of a little office in Connecticut. And it was actually news to the CEO when it all happened. It's true. No, it was true. It's true. I mean, there are going to be a lot of books written about this, but that's going to be one of them. Certainly Hank Greenberg, who was pushed out of AIG, knew not much about it till later as well. And of all people who should have known, it was Hank, even though he was already pushed out as CEO. So basically, what made the lower grade stuff saleable was the credit insurance market. And for them, their perspective was houses never fall in value. There's no risk. They're paying us to insure something that never happens. The event never happens. They're paying us against tornado insurance in Austin. Well, that does happen. How about volcanoes in Austin? That doesn't happen very often. They're going to pay us a lot of money to insure this stuff, and we don't have to show it on our books and even report it to the regulator, which was quite amazing to the New York State Commissioner of Insurance. It was quite amazing. I mean, he was caught with his guard down, to say the least. So basically, that's how they moved the stuff abroad. And the poorer stuff, interestingly enough, didn't go to the banks. It went to the hedge funds. Now, on top of that, there's another way they disposed of the really poor stuff. There was real problems in getting rid of this stuff. And so the investment bankers are very creative people. They're also excellent at marketing. So what they did is took these lower tranches that they couldn't credit enhance enough to get the hedge funds to buy. They then put into a new structure called, and actually I didn't do this chart, but it's called a CDO. This is marketing, a collateralized debt obligation, that terminology. We got to create a new package of dogs and cats and get it, and then tranche it so whoever's first in line is protected, because there's a lot of debt behind it. Unless everything fails, they're going to get paid. And the big thing is, can they convince the rating agency that indeed the best stuff, the top first in line was indeed AAA. Well, here was the approximate numbers that were going on. It was called CDO securitization, and this is the AAA rated tranches. And what went into that whole portfolio of dogs and cats were the marginal stuff that they couldn't sell otherwise, let alone the stuff down here. And the amazing thing is the rating agencies allowed them to put 75% of the first tranche, which was AAA. On one theory, the point is that's how the Titanic was built. And so the conveyor belt was now complete, and it was not just residential mortgages, but we have other issues coming, which are commercial. We have another one coming down the pike, which has, as of last week, we've gotten some new information on prime residential mortgage rates. Defaults continue to rise. This is what, prime, subprime? Well, this is prime, and this last block is the first quarter of 2009. And it made a lot of news when the prime keeps marching upward. And these are delinquencies, not defaults. But the first step of a default is a delinquency, and it usually goes 30 days, 60 days, 90 days, and then you go into default, and then you go into foreclosure, and then you go into bankruptcy. And the prime, we're hitting the primes now, and we're hitting the primes because the unemployment rate is rising. So it continues. By the way, it's not only in the mortgage area, residential mortgage area, but we have a major tsunami coming in the commercial mortgages, because we're in a recession and we're having a great cutback of spending, and we're having an awful lot of retail shops that are going out of business and going dark. Best Buy is the first of many, and the rent rolls are falling. So we're going to have the same thing with a commercial mortgage.
Circuit City.
Circuit City. Thank you. Thank you. Thank you. I didn't want to create a run on Best Buy.
Cause a run on their stock
unnecessarily. I have to remember I'm no longer in class. I have to be careful if this goes out on the air.
We'll edit it.
Thank you. Okay, so that's the conveyor belt. That's the financial conveyor belt and how it got built. Now the question is, how did it melt down?